You know that feeling when you're watching your trade climb higher and higher, and every fiber of your being is screaming to hold on for just a bit more. That moment when your account is up 15%, then 20, and you start imagining what you'll do with those gains when it hits 30. Here's what nobody tells you. That exact moment, that greedy whisper in your ear telling you to wait, is probably costing you more money than every losing trade you've ever made combined. I'm going to share something with you that goes against everything you see on social media, everything the guru crowd preaches, and everything your trading buddies brag about at happy hour. Taking profits early, the thing that makes you feel like you're leaving money on the table, is actually the secret weapon of consistently profitable traders. And I'm not talking theory here. I'm talking about real money, real accounts, and real psychology that separates people who make a living from the markets from those who keep blowing up their accounts. Let's start with a truth bomb that might sting a little. Most traders, and I mean the vast majority, don't lose money because they're bad at picking entries. They lose money because they have no idea when to get out. They'll spend hours analyzing charts, drawing perfect trend lines, calculating risk-reward ratios that would make a mathematician weep with joy, and then completely fumble the exit because they're either too greedy or too scared to pull the trigger. Think about the last time you had a winning trade. Really think about it. You probably entered at a decent spot, watched it move in your favor, felt that rush of excitement, and then what? Did you ride it all the way back down because you wanted more? Did you watch your unrealized gains evaporate because you convinced yourself it was going higher? If you're nodding your head right now, you're in good company. This happens to everyone, from complete beginners to traders with decades of experience. Here's where it gets interesting. Studies of actual trading behavior, the kind where researchers dig through millions of real trades from real accounts, show something remarkable. Traders who consistently take partial profits and exit positions earlier than optimal tend to have better overall account performance than traders who try to squeeze every last pip out of a move. This seems completely backward, right? How can leaving money on the table make you more profitable? The answer lies in something called compounding consistency. When you take profits early, you do several things that transform your trading psychology and your bottom line. First, you lock in wins regularly. These wins aren't theoretical numbers on a screen that might disappear tomorrow. They're real money that hits your account and stays there. This creates a psychological reinforcement loop that's incredibly powerful. Every time you bank a profit, even a smaller one, your brain gets a hit of satisfaction that strengthens your discipline and confidence. Compare this to the trader who's always swinging for home runs. Sure, when they hit one, it feels amazing. They'll tell everyone who will listen about that one trade where they caught the entire move and made a killing. But what they won't mention are the dozens of times they watched huge unrealized gains turn into small wins or even losses because they held too long. What they definitely won't talk about is how this pattern slowly destroys their confidence and makes them second-guess every decision. Let's talk numbers for a second, because this is where it really clicks. Imagine you're a day trader and you target $50 per trade on average. You take your profits when you hit that target, maybe letting a small portion run if conditions are perfect, but mostly you're disciplined about banking that $50. Over a month, hitting this target just 3 times a week gives you $600. Not sexy, not impressive to brag about, but consistent and real. Now imagine the trader who's trying to turn every trade into a $200 winner. They'll hit that target occasionally, maybe once a week if they're lucky. But the rest of the time, they're watching their $50 winners turn into $20 winners because they held for the bigger move that never came. Or worse, they're watching winners turn into losers because they refuse to take the small profit. At the end of the month, they might have made less than the consistent trader, but they've put themselves through an emotional roller coaster that leaves them exhausted and questioning everything. The power of taking profits early really shines when you look at win rates. A trader who takes profits at reasonable targets might have a win rate of 60 or even 70%. This means they're winning more often than they're losing, which does incredible things for their psychology. They trust their system. They trust themselves. They can take losses in stride because they know their next winner is probably just a few trades away. The trader chasing bigger moves might have a win rate of 40% or lower. Even if their average winner is bigger, the psychological toll of losing more often than you win is brutal. Most people can't handle it. They start revenge trading after losses. They hesitate on good setups because they're afraid of another loser. They override their system at the worst possible times. All of this compounds into a downward spiral that has nothing to do with their actual trading skill. Here's something else that doesn't get talked about enough. Taking profits early protects you from the market's most dangerous characteristic, its complete unpredictability in the short term. You might have the best analysis in the world, perfect entry timing, and a setup that looks absolutely flawless. And then some random news headline drops, or a big player decides to take profits, or market sentiment shifts for no apparent reason, and your perfect trade reverses hard. If you've been holding out for the maximum possible gain, you just got burned. If you took profits at a reasonable target, you're already out with money in your account. The concept of satisficing versus maximizing comes into play here. Maximizers are people who always need to make the absolute best decision, get the absolute best deal, extract the absolute maximum value from every situation. Satisficers are people who aim for good enough, for solutions that meet their needs even if they're not absolutely optimal. In trading, satisficing wins every single time. When you adopt an early profit-taking strategy, you're essentially saying that good enough is actually great. You're acknowledging that you can't predict the future, that you don't need to catch every move, and that consistent small wins beat inconsistent big wins. This mindset shift alone can transform your trading results. Let's address the elephant in the room. What about those traders who do make fortunes by holding positions for massive moves? They exist, absolutely, but here's what you need to know about them. First, they're incredibly rare. For every trader who catches a huge move and holds it perfectly, there are thousands who tried the same thing and failed. Second, even those successful trend followers take profits. They just do it differently, often using trailing stops or scaling out as the move progresses. They're not just white-knuckling through volatility hoping for the best. Third, and this is crucial, those traders have usually blown up multiple accounts learning how to do it right. They've developed the psychological fortitude to sit through massive drawdowns and the discipline to stick to their system when it feels completely wrong. Most people don't have the capital, time, or emotional resilience to go through that learning curve. Taking profits early is also a form of risk management that doesn't get enough credit. Every moment you're in a trade, you're exposed to risk. It doesn't matter if you're up big or down big, the market can do whatever it wants next. By taking profits and getting out of positions, you're reducing your exposure to that uncertainty. You're giving yourself optionality. You can reassess, wait for the next setup, or even re-enter the same trade if conditions remain favorable. Consider the trader who's up nicely on a position, but decides to hold through a major economic announcement because they think the trend will continue. Sometimes they're right. But often, that announcement causes volatility that stops them out or significantly reduces their unrealized gains. The trader who took profits before the announcement has zero stress. They can watch the chaos unfold with detached curiosity and look for the next opportunity once things settle down. There's also the practical matter of how taking profits affects your trading plan and discipline. When you have clear profit targets and you actually hit them regularly, you build trust in your system. You prove to yourself that your edge is real and that following your rules works. This makes it exponentially easier to stick to your plan during drawdowns or when you hit a string of losses. You've got a track record of success to fall back on. The compounding effect of consistent profits is real and powerful. Let's say you start with a $5,000 account and you make 5% per month by consistently taking early profits. That doesn't sound exciting, but it compounds to over 80% annual return. Do that for a few years and you've built serious wealth. The trader swinging for monthly home runs might hit a 30% month occasionally, but they also have months where they give back 15 or 20%. Their equity curve looks like a heart rate monitor, and their actual long-term returns are often mediocre or negative. One of the most underrated benefits of taking profits early is what it does for your life outside of trading. When you're not constantly monitoring positions hoping they'll go higher, you're free. You can focus on other work, spend time with family, enjoy hobbies, and live your life without being chained to charts. Trading becomes a part of your life that adds value rather than consuming all your mental energy. The stress reduction alone is worth it. Holding positions while hoping for bigger gains is exhausting. You check your phone constantly. You wake up at weird hours if you're trading international markets. You can't relax because in the back of your mind, you're always wondering if you should take profits or keep holding. When you take profits at predetermined targets, you eliminate this stress. You execute your plan, take your profit, and move on. Here's a practical framework that works for a lot of successful traders. They scale out of positions. When a trade hits the first profit target, they take half off. This locks in a guaranteed win. Then they move their stop to break-even on the remaining position, creating a free roll situation. If the trade continues in their favor, they take another portion off at the next target. Maybe they let a small piece run with a trailing stop to catch any extended moves. This approach gives you the best of both worlds, consistent profits plus the occasional bigger win when conditions align. The key insight is that your worst-case scenario after taking partial profits is banking a modest win and breaking even on the rest. Your best case is banking that modest win and catching a bigger move with your runner. You've removed the scenario where you watch a big unrealized gain disappear completely, which is the soul-crushing experience that ruins so many traders. Taking profits early also forces you to take more trades, which might sound counterintuitive but is actually beneficial. More trades mean more opportunities to apply your edge. If your edge is real, the more times you execute it, the more money you make. Holding positions for extended periods hoping for huge moves means fewer total trades, which gives variance more opportunity to hurt you. With more trades, the law of large numbers works in your favor if you have a genuine edge. The bottom line is this: trading isn't about being right in some absolute sense. It's not about predicting the future perfectly or catching every possible dollar the market has to offer. Trading is about making consistent decisions that give you a mathematical edge, and then executing those decisions enough times that the edge expresses itself in your account balance. Taking profits early is one of the most powerful ways to achieve this, because it aligns your strategy with human psychology and market reality. You're not leaving money on the table when you take profits at reasonable targets. You're collecting money that was never yours to begin with and putting it safely in your account where it can compound. You're building confidence, reducing stress, and creating the psychological conditions for long-term success. You're acknowledging that good is good enough and that perfection is the enemy of profitability. That's not settling. That's wisdom, and it's exactly what separates consistent winners from everyone else who's still searching for that one perfect trade that'll change everything.